Welcome back to Indianomics. This edition is your keyhole to Jackson Hole. Well, in 2005, the then IMF chief economist, Rajan, had presented a paper in Jackson Hole arguing that the market developments at that time were creating a probability of a catastrophic meltdown. He was ominously right. 10 years on, Professor Rajan is again at Jackson Hole as the Reserve Bank of India governor. Let's hear out what he has to say of global volatility, China, Fed rate hikes, and of course, Indian rate cuts.
Thanks for joining us.
Thank you for having me.
You have growth, you have inflation, you have a central bank discount rate that's not at zero. Do you feel alone in there?
Well, it's a nice set of problems to have, I think, in this world, to have a little bit of the traditional problems of some inflation, but a fair amount of growth.
So you have nobody to talk to because you have 6% inflation and you're still trying to get it down.
Well, I have to look to history. I look to how these economies were maybe 10, 15 years ago, learn from that.
Let's talk about some of the recent news. Among the things, you are right, neighbors with China, a huge trading partner with China. How has the Chinese devaluation affected you?
Well, we are big trading partners with China, but typically they export to us, we export relatively little to them. So if in fact there is a greater Chinese slowdown than is anticipated, it won't affect us as much as other countries around the world. Of course, everybody would like stronger Chinese growth, but to some extent, we're amongst the least affected.
Do you feel like they're doing the right thing right now to get their economy going and taking the right measures?
Well, I think the longer-term transition they're looking at to move towards a more consumption-oriented economy is absolutely the right thing. They have to do it. And of course, the transition path can be a little fraught with uncertainty, and that's what we're seeing.
Not only are you alone inside there, but also back in India, you have some criticism. You're running with a 7.25% discount rate. And people say, hey, it's time to cut, given where everybody else is around the world. How do you defend that kind of interest rate when there's other people around the world with zero?
Well, we also have inflation, which other people don't have. So we have to look at the difference and make a judgment. We've cut interest rates 3 times this year, and we're still in accommodative mode. We'll look at the data as it comes in and take a further view. So we've not said we've finished. We said we're looking at the data and we'll take a view as the data allows us.
Kelly?
Mr. Governor, you told a meeting of central bankers, including Alan Greenspan, that there were fault lines hidden within the financial system globally, and in short order you were proved right by the financial crisis. How do you see things today?
Well, I think the central problem today is really slow growth. And if we could find the magic bullet to make growth stronger, I think you would see a lot of the difficulties around the world vanish, whether it's the difficulties the emerging markets have, partly a result of not being able to export to stronger industrial country growth, or the difficulties that some industrial countries have with their high debt. So what we really all need is stronger growth, and we're all sort of trying to figure out where the secret sauce lies to restore the pre-financial crisis growth.
Sure. A lot of that high debt outside of this country is still in dollar terms. From your point of view, how significant a risk to the global financial system is an appreciating U.S. dollar?
Well, it does cause some fragilities, but on the other hand, if it is accompanied by very strong U.S. growth, it does help other countries who can then export to the United States and pick up their own economies on that basis. So there are positives and there are negatives. Absolutely, the fact that a lot of debt is denominated in dollars, especially certain amounts of corporate debt around the emerging world, does create fragilities.
So I just want to follow up on Kelly's question there. You're not arguing to United States Federal Reserve officials not to raise rates. You don't have a strong opinion in that regard?
Well, I think my position over time has been don't do it when the world is in turmoil. Because it's a long anticipated event. It has to happen sometime. Everybody knows it has to happen. But pick your time. And I think if the volatility we've seen calms down, as it seems to be, it could happen sooner rather than later. I don't think people would have a problem with that. It has to happen at some point.
Just a short thing. You're the only central banker in the world that has to pay attention to the monsoons. Monsoons cause inflation in India.
Well, monsoons also cause a lot of rural well-being if they're good.
If they're good.
And rural consumption, because 45% of our people are farmers, is such a strong tailwind to growth. So we're hoping for a good monsoon, so in fact we can have consumption growth from rural areas support industrial growth.
Governor, thank you so much for joining us.
Thank you.
Well, at least we have one assurance from Rajan that he's not done with cutting rates yet. Okay, let's turn to Steve Leesman himself. He's one of the very few journalists allowed to attend the Jackson Hole Symposium. He can't report on the off-camera, the dinner table chats that he has with central bankers, but he can tell us his own thoughts, which of course would be framed after listening to the folks at Jackson Hole. So important to hear him out. Steve, welcome to Indianomics. First, tell us, to the extent you can, what are the folks at Jackson Hole telling you about when the Fed will move on rate hikes?
As best I can figure out here in Jackson Hole, September is very much up in the air. We know the Fed wanted to move in September. We know that was something that was very much on their radar as a possibility. It was never definitive. It was always something that was something they prefer to do. They want to get off the zero lower bound and raise interest rates. But the recent market turmoil, along with Chinese economic weakness, the stronger dollar, commodity prices down, has made it, I think, the best operative word or phrase was used by Bill Dudley earlier this week, not here in Jackson Hole, but in a press conference he gave in New York City, which is that it's less compelling. Now, we have to kind of unpack that phrase. It's not uncompelling. It's not off the table. He went on to say, look, between now and when the Fed meets in September, September 16th and 17th, it could become more compelling, he went on to say. So I think we have to point towards that August employment report in early September and the other economic data, which certainly has been both stronger for the U.S. and stronger relative to other countries.
Well, Steve, you recently authored a poll of Fed governors and others for their view on when the Fed will hike. Now, the poll said chances of a hike in September have dimmed. Now, after Jackson Hole, if you were a respondent to this poll, what would you say the odds are for a hike in September?
In September, you're the first person to ask me that since I've got here. And going into this place, I had it about 60% chance of a rate hike. I guess I'd put it down below 50%, maybe towards 45% for September right now. When they look at history, they believe the mistakes the central banks have made. 1937 in the United States, Japan in the 90s, was moving too quickly. And that's what history tells them. That's the lesson they take. And so if they're going to make a mistake, they're going to wait a little bit. If you think back to the taper tantrum that happened, it's pretty interesting. What they did is they came forward, they floated this idea of stopping QE or winding QE down, and the market had a huge fit over that. And so they let it sit for a while, things went stable, and they came back and did it again. What we're doing now every day with Federal Reserve policy is absolute history. Never been done before. The exit from the zero lower bound, never been done before. I don't think it's surprising, and it's maybe to be expected, that there could be a couple stabs at this, where they come forward, they float an idea of September, and maybe you get this market volatility, Fed backs off, waits, has its long-run policy in mind, and then comes forward with it again. So that would raise the odds of a December rate hike as well, and depending upon the economic data, still presents some chance of September, but I'd say less than 50%.
Well, Steve, does anyone out there fear that asset prices are in bubble terrain in the U.S. or in any other major asset market, such that a major meltdown may be expected sometime in the near term or the medium term?
Well, I don't know about quite that extreme, but certainly Marty Feldstein is a person who believes that you could have a pretty big sell-off if the Fed moves the other way. I do want to give you my point of view on this, which is that a lot of people tend to think that what happened before is most likely to happen next. And because of that, you had this big crash in 2008. And so everybody thinks that if something goes up, it's a bubble, and when it comes down, it's a crash or a meltdown. I don't think that's the normal state of the world. In the normal state of the world, things go up and they can become overpriced, and then they can go down in value and they can become less valuable. That's a normal state of the world. A meltdown or a crash is a very set of specific circumstances that's needed. I think everybody sort of sits on the edge of their seat these days, and their palms are all sweaty about the next meltdown or bubble because it wasn't that long ago that we had a next meltdown or bubble, and that's understandable. And if you think about it, it was 20 years after the Great Depression before Americans, or even 30 years, before Americans felt comfortable enough to own stocks again. I believe we're living in that wake, but I look at it much more sort of calmly. Yeah, things get into into overpriced territories, but it doesn't mean they crash. It doesn't mean that there's a major meltdown as a result.
Well, thanks a lot, Steve, for that observation. Well, now let me play out to you views of two Fed governors. One, Narayana Kocherlakota, the Fed governor from Minneapolis, who argues against a hike. In fact, he even wants a QE4. And at the other end, Esther George, the governor from Kansas, she wants a rate hike in September.
You know, barring big changes in the data between now and September, because we're all, of course, looking at the data to formulate our outlooks. Barring that, I don't see a near-term increase in interest rates as being appropriate. And by near-term, I mean really through the rest of 2015.
Mm-hmm. So I've been talking about the normalization of rates for some time. This week's events complicate the picture, but I think it's too soon to say it fundamentally changes that picture. So in my own view, the normalization process needs to begin, and the economy is performing in a way that I think it's prepared to take that.
Well, we've heard them all. So what are the key takeaways? One, Fisher's made it very clear the Fed hasn't made up its mind on a September hike. Two, they will closely watch the labor data that comes next week, the non-farm payrolls. Three, they want to raise rates, and they are confident that inflation will rise to 2% when the transitory impacts of lower commodity prices have played out. Four, Steve says, and that's usually the general opinion, Steve says after listening to everyone, Fed rate hike is more likely in December rather than September. And finally, on to Rajan. Rajan believes we are better off if the Fed rate hike is sooner rather than later. And sixth, the most important takeaway, Rajan is not done with cutting rates yet. And finally, to end where I began, with the global markets, no one in Jackson Hole seems to believe there is a huge meltdown in the markets round the corner. That's the best takeaway then. Thank you for watching this edition of Indianomics.